Now, let's try to understand and discuss this concept of back testing the value at risk. First of all, we can very well appreciate the fact that whenever we bring in the value at risk, we are talking about, we need to really elaborate how it has been calculated, what data did I take for calculation of it, did I go with the P&L data? Did I go with arithmetic returns? Did I go with geometric returns? How did I really compute it? And how can I really link it with the actual performance? Right? If I am not able to, if I am not able to predict the future risk properly, right? If the future risk is not getting predicted properly, what is the need of this VAR model? So, which means any model that we are bringing in, there needs to be a sufficient validation that has to be done for it. Checking the accuracy or adequacy of the model. To what extent the model is really fitting the requirement, right? So that is very much essential. Any model we are building for whatever purpose. Now what we say is there are various mechanisms which are helping us to do that model validation part. And one of such kind of tools which helps us in testing the adequacy of the model is backtesting. Apart from that, we can also have a few models which are like something like stress testing, or probably I can talk about the independent review of the work product, or independent review of the model, doing a kind of oversight on it, providing the adequacy of the model or fitment of the model to the requirement. So here let me talk about the back testing, which is one of the core processes which can really do the validation of the model. This is purely a statistical framework, right? Back testing is a pure statistical framework wherein I am trying to verify the actual losses against the projected losses. So my VAR model will give me some kind of projected losses. Okay, it says there is a 5% chance that the losses, the daily losses will exceed some X. That is what it says, 95% confidence interval VAR for a daily returns is some X, which means there is a 5% chance that the losses could be more than that. Now, what I would like to see is compare the actual losses. Okay, in every 100 days, typically 5 days, the losses could be more than X. And that is what I want to compare. So I will verify the actual losses, whether they are in line with the projected. Right? So we are simply looking at comparing the history, the historical VAR forecasts that are there, whatever the VAR forecasts that have come up historically, I am looking at the actual returns that have come up, and finally seeing in how many cases there is exceeding the VAR forecast, whereas what is the VAR forecast talking of, how many days it should exceed. So it is primarily doing some kind of a reality check on the computed VAR. So just to make sure whether my model is well designed or not, probably this kind of mechanism is very much required, because if my model is faulty, I can really look at it whether the assumptions that I have taken into the model have some problems, or the parameters that I have chosen for the model, do they have some kind of issues? Are they calculated, are they estimated incorrectly? The modeling formulas itself, did I do them Did I do them the modeling process and the modeling calculations? Did I do them any kind of problematic? Such kind of re-examination can very well be done, which can result in improving the model consistently. So even backtesting can help me in terms of the model improvement also. And even more, probably if you look at the Basel, which is a regulation for the banking industry, which is a standard for the banking industry, they have said that the banks can use actually the internally built models for computing the value at risk. Now, think of this bold step which has been taken by Basel. They can use their own internal models. Now, there is a very strong possibility that the banks are going to understate the risk. Now, this is where again backtesting is coming into picture. Just because of the backtesting as a concept, the Basel had that confidence in allowing the banks to use their internal models for capital requirement. So they have brought in some rules with respect to backtesting, which will specify the number of exceptions that can come in the model. So, and based on that, they are even putting a penalty in terms of the VAR that needs to be set, the capital that needs to be set based on the VAR requirement. So, which means the backtesting had played a very important role in the for the banks to really take a decision regarding allowing the banks to use their own internal model, because the intention is any backtesting that we are doing, it should really identify who have willingly understated the risk, but at the same time it should be able to distinguish those under those VARs that have exceeded purely because of bad luck, those returns which have exceeded the VAR purely because of bad luck. So there should be some kind of mechanism which will distinguish these two. So if I say 5% of the observations can exceed the VAR, which means 5 out of 100. Should it penalize for 6? Should it penalize for 7? Now this is where, because 6 and 7 could be purely because of bad luck. But if the same number goes to 20, then probably there is a problem with the model. Now this is where we talk about on what basis I should look out for this kind of a distinction. So the backtesting model needs to address this kind of problem as well. Then any backtesting model should really be helpful in terms of comparing. It should facilitate the comparison process of the actuals with respect to the predicted model. And we know that VAR itself is based on a kind of confidence level. Means it itself says some percentage of the observations will lie outside the VAR. Right? So whatever are the actual values, which are the actual losses which are exceeding the VAR, we are calling them as exceptions. So if there are too many exceptions, probably you have underestimated your risk. Means the number of times the exceptions, if the losses are much greater than the required, we are looking at too many exceptions. The model is underestimating the risk, which means I am allocating too little capital, right? Because I have underestimated, allocated capital also going much lesser. But on the other side, if my losses are too, if the exceptions are very low in number, even we are looking at inefficient allocation of the capital. I did not allocate the capital properly. Now this is what we really look at on a regular basis, right? We should see that we can very well do a plot between whatever has been the predicted the number on a daily basis, I can look at it like the predicted number of exceptions, and I can bring in the actual number of exceptions. So probably over a 45-degree line, anything that is above, they are really called as exceptions because the actual number of deviations above the predicted are much higher. Now, at least for a few, it is allowed. But anything, let's say probably if I am setting 2% of the observation, so anything if this number is falling into 2% of the observation, the model is very well calibrated. But if the number of exceptions are much more than that, there is some kind of a problem with the model. Now, here comes one interesting point to be discussed. Okay, we talk about the returns. So, the actual returns, right, to what extent, or actual losses, to what extent they have exceeded your VAR. Now, here comes the value at risk as a definition itself. We remember that it is assuming that your current portfolio is frozen over the entire horizon. But in reality, the trading happens intraday quite often, which means the actual return is completely different, which will keep changing by buying and selling of the securities, whereas VAR assumes that the portfolio is frozen over the time period. So any intraday, but the actual return actually contains all the intraday trades, profit items, fees, commissions, spreads. All these things are included as a part of the actual return. So which means there is a difference. So if I am using the actual returns for computing the VAR, I cannot use it. Right, the computation of the VAR, I will not use the actual returns. I will try to go with the hypothetical returns only. For the computation of the value at risk, I am coming out with the hypothetical returns where I am assuming the fixed positions of the portfolios. Right? So even while I am doing the comparison, I have to do it with respect to the VAR that has computed, the VAR that has been computed. Against that, I will measure the hypothetical returns, not the actual returns. But yeah, if I am looking at the back testing for very small time periods, probably a daily kind of stuff, very rare that the portfolio balance can be changed that drastically, but still intraday kind of a trading can very well contaminate the portfolio too much. Now that's the reason we are talking about, we will generate a kind of a hypothetical return that very closely comes out to the VAR forecasted combination that we have come out with. So it's a frozen portfolio where I am bringing the fixed positions that I am multiplying with the actual returns, and those returns are being really taken as the basis for the backtesting mechanism. So that is one thing we have to understand. We will use the hypothetical returns for the comparison purpose. We will not use the actual returns. Or in some cases, there is even a mechanism called cleaned returns. When I am using the word cleaned returns, it is nothing but actual return minus all the non-mark-to-market items. Right? Non-mark-to-market items like your fees, commissions, whichever are not mark to market on a regular basis, I delete all of them, or any kind of net interest income, they are excluded, and the return that comes out is the cleaned return. Now what we say is, for comparison purpose, either this or this can very well be used. So finally we are using some of this. Let's say if I am using the hypothetical return and comparing with the VAR, So whatever are the deviations, I am understanding the deviations and actually coming out with the correction mechanism. But if I am doing it with the actual returns and computing the deviations also, actual returns can be helpful for some other purpose. Actual returns will talk about the real P&L, how well the company is performing, what is the typical volatility that has been included with respect to the return. All these things should come with the actual returns, not the hypothetical returns. So which means it's better to do the exception comparison both with the hypothetical returns as well as the actual returns, because in some cases if the model is good with the hypothetical return but it is not good with the actual returns, which means I can say there is some problem with the intraday trading, right? And in some cases, let's say with the actual returns the model has gone good, model calibration was good, but with the hypothetical returns it is not good, which means my model creation itself is having some kind of problem. So in some cases, by doing a comparison both with the actual returns as well as the hypothetical returns, we can even bring out some useful conclusion. But at the end, what we are trying to understand here is backtesting is a very powerful tool which helps us to really compare the actual compare the returns, compare the profits and losses against what has been computed for VAR, see the number of exceptions, and then based on that take your capital requirements accordingly. Right, so one of the most powerful processes in risk management becomes goes with the backtesting. All right. Now let's look at how do I really do the back testing based on the failure rates. There are different models where I can do the back testing. One is using the failure rates. Then there are a few ways of doing the back testing using the Basel rules. The Basel has specified a few set of rules which can very well be used for back testing, and I can even rely on conditional coverage kind of model. So right now we will look at the failure rate kind of a model for understanding the backtesting of value at risk. Now first of all, just to recollect, whenever we are using the backtesting, we are doing a comparison between the historical VAR measure that we have computed against the returns that got generated during that period. For each of the period, I am looking at the historical VAR and looking at the actual return that got generated in that subsequent period. Now, first of all, we all appreciate the fact that VAR is always at some confidence level only. So probably if I am saying 95% confidence level VAR, which means at 95% confidence, 5% of the observations are going to exceed the VAR. That is the meaning of it, right? So there is a possibility that some observations are going to exceed that VAR number, and some cases it may be slightly more than 5% also, 6, 7, 8%. So if it is high, then should I say that the model is bad, or should I say that it is purely a bad luck? Now this is where exactly 5% should not contribute to exactly 5. There should be some kind of accept or reject decision that comes. At what point I take a decision regarding rejection of the model? Up to what point I say that it is purely a bad luck? And where should I really make a decision that this model needs to be rejected? So there should be some kind of a confidence level. So probably I can talk about, okay, for the 99% value at risk, I will talk about the 95% confidence interval. So this is what is a back testing. So here we are talking of two different percentages. Now we should not get confused. The confidence level here is not at all associated. This is purely for decision taking, and this is the number that goes into the computation of VAR. So I can say 95% confidence interval for back testing on a VAR which is really built with 99% confidence level. So I have to really understand the difference between these two numbers, right? Because the choice of the test here, this is the test that I am performing. The choice of this test is not at all related to the VAR computation at all. I may do the same for a 95% VAR or 97.5% VAR. I can do anything. So the decision criteria is completely different from the percentage that we are using for the VAR computation, right? Now, if I have to go with the failure rate mechanism, the first thing is identify the failure rate. So basically it is like that proportion of times VAR has exceeded in a given sample, right? Proportion of times VAR has exceeded in a given sample. So which is purely, I'm talking about it as P. The proportion of times. So the VAR figure, okay, the VAR figure, let's say I'm computing it at a confidence level of 1 minus P. So P is, as per the VAR model, P is the significance level. Those P% of the times there could be exceptions. So what I really want to look at is, I'm trying to compute the failure rate, right, which is proportional to, which is a proportion of number of times the VAR has exceeded in a given population. Now, how many times the actual loss has exceeded the previous day VAR? So if I look at N is the number of days where there is an exception out of the T number of days which I have looked at as the sample, right? So these are the number of exceptions in actual. These are the actual proportion of exceptions which I am calling as the failure rate. Now what we typically talk about is this failure rate should be more or less an unbiased estimator of P. As per your VAR model, what proportion of the observations are really exceeding, should really exceed. So as the sample size T increases, what we simply say is the failure rate N by T should be more or less approaching the P. Now, here I really want to know for different values. Let's say P I am setting as just 1%. Means I am talking about a computing 99% value at risk, right? Now I want to know whether N is too small or too large for this. So, or I want to know what is the confidence interval, 95% confidence interval for this N, which will say that N is too large, which N is decently large, it's not too large, it's not too small. Now, this is where a few things we have to understand. It is really distribution agnostic. It is not making any kind of assumption regarding the distribution. So I can look at a normal distribution or some kind of skewed distribution, fat tail distribution, any of them. It's only based on the number of exceptions that are coming up. So which means I can very well treat it as a very powerful non-parametric mechanism. And what this mechanism simply says is, it is purely based on Bernoulli trails or what is called as the binomial distribution. What is it saying? The number of exceptions x, right? The number of exceptions, it follows a binomial distribution. So the probability density function is TCX, the number of exceptions. So we are talking about TCX, p to the power of x 1 minus p to the power of t minus x. And of course the expected value of x is coming out to be the probability times the number np or pt here. The variance of x is coming out to p into 1 minus p into t. And we know that when t is very, very large, the binomial distribution will converge to normal distribution, right? So the z is, I can convert it into a standard normal distribution using the central limit theorem. It gets translated as x minus pt divided by sigma, which is square root of p into 1 minus p into t. So this becomes more or less similar to a standard normal distribution, which is having a mean of 0 and a variance of 1. So this is the traditional way of understanding the number of losses or the number of exceptions. So which means because it becomes a Z test, I can look at a 95% confidence interval as nothing but plus or minus 1.96, right? The cutoff value of Z comes out to be plus or minus 1.96. So I can very well find out this standard deviation, and I can look at the mean value plus or minus 1.96 standard deviation. As long as it is lying within that interval, I say that the exceptions are not too many or too low. But once it crosses the interval, I can very well go with the rejection of the model. So that is where we can really look at. Now let me look at a few interesting observations. Let me take a small scenario. Let's say I want to take the p as 0.01, which means I am looking at 99% confidence interval VAR. Right, I am looking at a 99% confidence interval, confidence level VAR. I am looking at t equal to 250. 250 days of data is what I am looking at. Now what I really want to see is for different values of n, I want to see what is the probability going with the binomial distribution model. So I'm looking at t equal to n equal to 0 means 0 exceptions, 1 exception, and like that let's say I'm looking at 10 different exceptions. And what is the probability going with the binomial model? I am looking at the combination. Either I can use it as normal distribution adjusted, or I can go with the binomial distribution, whatever. So NCX times P power X, P power N, right? NCX P power N, P power X multiplied by 1 minus P to the power T minus X. Okay, this comes out as 0.08 and probably it goes something like this. Now what we are simply saying is, now look at it. If I plot a small chart for this, right, I plot a small line chart. Let me ignore this, or probably I plot a column chart instead of a line chart. Okay, so this is a line chart that is coming out. What is clearly coming out for me is Okay, there are one exception, the probability is this much, two exceptions, the probability is this, 3, 4. Now, what I am really looking at is what is the mean? What is the mean number of exceptions here? The mean is around 2.5, and the variance of the exceptions, if I am going with the binomial distribution itself, mean times 1 minus p is what is the variance. So the variance is 2.475. Square root of the variance is giving me standard deviation. So if I am looking at this being the mean, this being the standard deviation of this, now let's say this particular model, I want to look at the type 1 error. What is the type 1 error? The probability, here we are talking about the probability of rejecting a correct model. Now, let's say I want to reject for values which are greater than 4. Right? Let's say this model is correct. Let's assume that this model is correct. Right? Let's assume that this model is correct. Now, if this model is correct, what is the probability of rejecting the model if there are more number, let's say more than 4 exceptions that come up, I am rejecting the model. Means I am doing, actually the model is correct, but I am rejecting it. What is the probability for that? It is somewhere around, or probably I can say, the probability of rejecting the model or probability of type 1 error. Type 1 error is probability that you reject the model even though it is correct. Let's say above 4 I want to reject it, which means I can very well take this out saying around 10.78% that this model will be rejected. Now let's say I have an incorrect model, right? Let's say I'm looking at, let's say P is some 0.3 with everything remaining the same. Let's say I'm talking about an incorrect model. This model is incorrect, which means I have to reject it, right? I have to reject the incorrect. But what is the chance that I'm not going to reject? So the chance, let's say I'm looking at 4 and below. The chance that I'm not going to reject this incorrect model. So let's assume for 4, the model is somewhere, let's say this model is incorrect. I have to reject this incorrect model. There is almost a 12.8% chance that I am not going to reject this model. So this kind is actually called as a type 2 error. The type 2 error is more and more associated with the probability of accepting or not rejecting an incorrect model. So we have to be really worried about these two kinds of errors. There is a kind of trade-off, right? It's a kind of a trade-off for us in terms of balancing between the type 1 and type 2 errors. It should be in such a way that both the errors should be low. That is what will create a powerful model for our case. So there should be a balancing between the two, which means initially first set a low type 1 error rate. Right, initially set up a low type 1 error rate, design a model in such a way that the type 1 error is much lesser, and then create a test which will create a very low type 2 error rate. That is when the model along with the test will actually become more powerful, right? So this is what typically comes up. So when the model is correct and the decision is also correct, it's fine. Model is incorrect, decision is reject, even that is fine. Model is correct, but the decision is reject. It is where it is coming out as a type 1 error. Model is incorrect, but I am still accepting the model. That goes as a type 2 error, and I have to be really comfortable in terms of assessing the same. Now, one major test, right? One major test that comes out in terms of testing the adequacy of the model is using a likelihood ratio kind of a test, which actually comes out with minus 2 log 1 minus p to the power t minus n, p power n. Now 1 minus p here, p is the probability as per the VAR computation, the significance level associated with the VAR, right? The confidence level that is associated with the VAR. The P is coming out to be, the P is coming out to be the significance level, which is 1 minus C, that is associated with the VAR. Whereas N by T is the actual number of deviations, actual number of exceptions. So this is what we are coming out as plus 2 times log 1 minus N by T to the power T minus N into N by T to the power N. So we are looking at two parts. One is with respect to the actuals. The other one is with respect to the other one is with respect to the VAR based probability or the confidence significance level. Now what it says is this particular log likelihood, this particular log likelihood ratio, this particular log likelihood ratio should be asymptotically distributed chi-square distribution with 1 degree of freedom. So when I look out for this value across my tables, it's simple that if the likelihood ratio is greater than 3.84, I reject the null hypothesis. Otherwise, I fail to reject the null hypothesis. So probably you can very well look out. Okay, let me take a simple example for us to work out, right? So let me take a simple example where we can work it out. Let me take different levels of probability. Let's say 0.01, 0.025, then 0.05, 0.075, and let's say 0.1. Now if these are the probabilities, I'll take the confidence levels on the for the VAR, which are nothing but 1 minus of the probabilities, which are working out to 0.99 and something like this. Now if I want to go with a T, which is, let's say, 252 days, one full year, I'm looking at 200 or probably let me round it up, 250 days, or 500 days 2 years, or 1000 days 4 years, right? These are the number. Now let's say n, let me talk about n equal to 1, right? So based on this, I can get my n by t's in each of the cases. If n is 1, or probably in each of the cases, let me write it here, n is 1 in all the cases. So n by t is becoming this divided by this. So this is becoming n by t in all the cases, right? Now I have the n by t, I have the p's. What I can very well do is I can compute, if n is 1, I can look out for the log the likelihood ratio, right? So let's use the formula for the computation. So the positive side is 2 times log 1 minus of n by t, right? Log 1 minus of n by t to the power t minus n. So t is 250, t minus n. 2 log, right? If I look at 2 log 1 minus of n by t to the power t minus n. T minus n plus, what else do I require? Sorry, minus 2 log. So I am talking about 2 into log. So this part has to be closed here. 2 into log minus 2 log. I'll write it as 1 minus p, right? I write it as 1 minus p to the power t minus n. T minus n. Okay, to the power t minus n multiplied by n by t, multiplied by p power n. So this is p to the power n. Right, the same thing I think I have to keep even on the other side as well. This is just taking about so this also it needs to be multiplied by n by t to the power n by t to the power n. Okay, all right. So now what traditionally goes is, this is the LR value that comes up. Now across, if I am seeing, these are the different LR values that are getting shaped up. Okay, 1 minus C, and we have 2 into 1 minus A28. Okay, here also I'll put a $A28. Alright, so if I'm dragging it across, I'm seeing these are the values, and probably if I'm dragging it across, now you could see if n is 1, these are the LR values. So which means wherever the LR is greater than 3.84, I can very well reject the same. So in all these cases, LR is greater than 3.84, which means I am rejecting the model. So in some cases, it is resulting in over predictions, in overestimating, and in some cases, it is more and more of under. So probably if I'm looking at that particular n, right? Probably if I'm setting this to be 3, right? If I'm setting n equal to 3 in all these cases, okay, for 1 year, it is still fine. For 2 years, it is still fine. It is not greater than 3.84. But if I am setting, but in case of here, you see that it is much greater than 3.84. So the model gets rejected in all these cases. But if the n is 6, you could see that here it is becoming it is not greater than 3.84 still. Here also it's not, but here it is still getting rejected. But if n is becoming 7, yes, in these two cases it's not getting rejected, whereas in this case it is getting rejected. So which means in this case n has to be lesser than 6. Now likewise I can very well identify the limits of n, in which range they will not get rejected and in which range they get rejected, which means if the value is too high or too low, there is a rejection that is traditionally coming out. So it has to be within a particular confidence interval. So if n is greater than, it indicates that so if n is much higher, It indicates that the actual number of exceptions are much higher. Your VAR model that is predicted is very low, which means there is a heavy understatement of the risk that is occurring. Similarly, you could see that as the sample size is increasing, right? Probably if at all I am putting the same 7, you could see that as the sample size is increased, in some cases it has come down and again it has gone up. So there is no pattern here. But the only thing is the interval, actually the confidence interval shrinks. The confidence interval shrinks as the size is increased, which means the more, if the data is very high, I should be able to reject an incorrect model very comfortably, which means the 95% confidence interval is a narrower interval. As T is more, my 95% confidence interval is a very narrow interval compared to it being much lesser. That's one major point that we have to really understand. And so that's one of the prime reasons. And if at all I'm looking at the comparisons, probably in some cases it's not that possible to build an interval quite comfortably if I'm looking at the 99% confidence levels and all that. So generally what the banks try to do is they try to compute the VAR for a 95% confidence interval and then try to identify the range of exceptions using using the back tested failure rate kind of a model, so that they get a limit both on the downward side as well as on the upward side. And once they compute the 95%, they do some kind of a multiplication factor on the top of it to adjust it to a 99% or 99.7% as required by the Basel or the regulatory kind of requirements. So that's a typical way out in terms of computing the VAR or backtesting the VAR using the failure rates kind of models. All right. Now let's try to understand what are the various Basel rules that are governing the backtesting mechanism. See, generally, compared to the financial institutions, the regulators have to operate in a completely different way. They have to come out with more and more broader kind of a framework. So they should develop some kind of models which are more and more comparable across the various financial institutions. So the way Basel has come out in terms of testing the various VAR models is purely based on the failure rate mechanism itself. We know in the failure rate, we have come out with some kind of likelihood ratio, which is unconditional likelihood ratio, which we have tried computing based on the VAR confidence level or the probability of exceeding with respect to the actual failure rate, which we have taken it as n by t. So based on that, the failure rate has been computed, a confidence interval has been generated for each one. Now based on that confidence intervals, it is basically driven like, initially we choose some type 1 error rate, right? For whatever we are going with, I'll choose the type 1 error rate, which is talking about the probability of reject a model when it is correct. I want it to be as much low as possible. But at the same time, I should not be penalizing any kind of bad luck, which means that's the reason we are talking about some kind of confidence level in which the number of exceptions can very well lie. But at the same time, there is a possibility of type 2 error, which is more of I am passing or probably I am not rejecting those models which are incorrect. Even this is a very serious problem. Now these two need to be addressed for any of the Basel based rules that are being set up. So this is where it is looking at, let's say we are talking about 99% VAR, right? 99% VAR. If I am talking of, there is a 1% chance of the VAR value, 1% chance of the returns or losses exceeding the VAR value, which means if I am looking at one day daily data for the last 1 year, approximately 250 days, I see around 2.5 instances where the exceptions can very well occur, right? Now what the Basel committee has done is, it has set some kind of a range saying up to 4 exceptions are possible. So what it has simply said is up to 4 exceptions, it has defined it as a green zone. Whereas 5 to 9 exceptions, it has defined as yellow zone. And anything above 9, which is 10 and more than 10, it has defined it as a red zone. So the moment it goes into the yellow or the red, the penalty starts kicking up. So the penalty is in terms of the multiplication factor. Here let's say the multiplication factor is 3 and probably it goes up to 4 when it typically crosses this 10 exception. So between 5 and 9 there is a possibility, like for 5 the penalty is 3.4, multiplication factor is 3.4, then it is 3.5 for 6, then it is 3.65 for 7, then it is 3.75 for 8, 3.85 for 9, and the moment it touches the 10, the penalty, the multiplication factor is going out to be 4. So this is where there is a progressive penalty that it has designed. And whenever it is in the yellow zone, whenever the exceptions are coming into the yellow zone, the penalty is purely up to the supervisor. Means there is some level of flexibility that has been created in the process. And it is purely based on the reason for the exception. And what the Basel has done is it has actually split the entire set of reasons into 4. The basic integrity of the model itself is a problem, which means the deviation has occurred because of the wrong reporting, data is reported wrongly, or the program code has been wrongly written, the formula has been wrongly written. So the integrity of the model itself is an issue. That's one kind of error or deviation. Is the deviation because of this, or we are talking about the model accuracy to be improved? Right now the model is not able to address all situations. So the precision of the model is not that good. It should be improved. So because there is some problem with respect to the model accuracy, that is where the deviation has come up. The third reason is because of the intraday tradings and the position changes, some kind of deviation has occurred. And the fourth is purely because of bad luck, which is more and more attributed to the market related variables. There is the volatility in the market has changed drastically. The correlation between the various market elements has changed drastically. So it has to be very clearly identified by the supervisor as to the deviation that has occurred in a particular day, the exception that has occurred in a particular day. What was the driving factor for this deviation? Now, if it is because of the first two, probably there is something to do with the model. So a penalty has to be applied mandatorily. And in the third case, probably the supervisor can very well consider. But in the fourth case, probably there might be a possibility of excluding from the penalty, provided probably the deviation came because on that day there was a very exceptional abnormal change in the interest rates, and because of that change in the interest rates the exception has occurred. Or is it because of a big change in the exchange rate on that day and that change has really impacted the exception? Or any kind of big political turmoil has occurred on that particular day which has triggered that exception? Or any kind of natural disaster or calamity has occurred on that particular day which is triggering the exception? So in this case, probably the supervisor is having the flexibility to adjust the rules and probably reduce some kind of penalty on the banks. Now here the most important thing is in the entire backtesting mechanism, how do I really segregate bad luck because of the market related changes from a faulty model? The whole crux in the backtesting process lies in this. So it is like balancing between rejecting a correct model, right? Bad luck is a correct model should not be rejected. So there was an exception, but the model is correct. So this is a type 1 error. And this is not rejecting a faulty model, incorrect model. So which is more like a type 2 error. These two should be reduced. There should be a balancing between these two kinds of errors, right? So now let's say I really want to look out on the data, right? Let's say I want to look at a p-value of 0.01 and I'm talking about 250 days of observation, right? So I can very well talk about the number of exceptions that can occur, where I am looking at it as a binomial and I am looking at the probability of the exceptions. So I am talking about 0 exceptions, then 1, then 2. Probably I am looking out for different number of exceptions, let's say up to 10. What is the probability there? Combination, I will have to use the combination formula. Combination of this TCX multiplied by P power X multiplied by 1 minus P to the power n minus x, which is T minus x. So which is giving me that the probability is 0.08 and it is going somewhere like this. So here if the rule is being set that anything above 4 is an exception, up to 4 exceptions are allowed. So the probability, even though it's a correct model, that the probability of rejecting or probability of a type 1 error is nothing but 1 minus of summation of all these, which is resulting in around 10.78%. There is a 10.78% chance that this particular model will be rejected. Now the same thing occurs if I am talking about what is, so for this particular model I also want to see what is the probability that the incorrect things would be rejected, or probably here let me just change a little bit. I'll set it to let's say 0.05. When I'm talking about 0.05, What are the expected numbers? So probably let me increase this to 20, right? Okay. Now let's say I want to find out in this what is the expected number. If I have to really look at the expected number of deviations that can be there, expected number of exceptions that could be there is around 5% of 250. So approximately there could be 12.5 exception, and I can set the maximum, right? I can set the maximum n by looking at my likelihood ratio. I can set, let's say, on the maximum side, let's say n is 17. So if it is 17 and above, I want to look at it like a type 1 error. So now if I look at probability of type 1 error here, I can very well talk about 1 minus of summation of all these, which is resulting in around 12.49%, right? But at the same time, if the model is faulty, I should be able to reject it also, right? What is the probability that I do that kind of, what is the probability that I do not reject an incorrect model? Now this is where I am looking at a type 2. Let's say this is an incorrect model, which means the number of exceptions are much in line. So probably I want to look out for the probability of the type 2, which means the model whose errors are much lesser, but still the model is wrong. So I have to really balance out between these two. So I am designing the model in such a way, first of all, that my type 1 error is lesser, and after that I'm designing a test in such a way that the type 2 is going to come down. Overall, the combination of type 1 and type 2 would result in how many times my VAR is going to be much higher than the actual VAR is, by how much times it is higher than that is actually reported. Now this is where we are talking about the different kinds of zones. Right, in the same, probably if I am looking at 0.1 or 0.01 as the probability, 99% VAR, I could see that the probability that I am rejecting beyond this is somewhere around 10.78%. Right, and the same way I can change it. Average exceptions, I'll look at the number of exceptions which are exceeding something, and I can, based on that, I can set what is based on that, what is the probability that the number of exceptions are exceeded. So probably if I am setting it around 0.05, I get almost 12.5% that that they are exceeded. And now if I want to look out for the minimum value, probably if it is around 12.5, the minimum could be somewhere around 8, and below 8 I could see that the probability of rejecting an incorrect model is somewhere around 6.5%. So by working out in such a way that the type 2, the probability of lying within a range is much higher, the probability of reducing the type 2 error is lower. So it is very easy to catch an erroneous model. If the probability of type 2 is going down, it is very easy to catch a erroneous model, and that is what will improve the power of the test. So that is what typically comes out when we are using the Basel based framework. Look out for the green zone, the yellow zone, and the red zone. Then whatever the model that we have looked at till now, they are majorly based on the unconditional coverage. What is this? It's a very interesting part to look at. I did not look out for any kind of serial correlation in the data. I said, okay, there could be around 10 exceptions or 12 exceptions or 4 exceptions, whatever it is. But we are making an assumption that these exceptions are evenly spread out across the year. It should not be the case that they are bunched up. And there is a very high possibility that in the real world, the exceptions could be very much bunched up. Between in the last 1 month, there could be a more number of exceptions. They are not evenly spread out, but they are more and more bunched up. So this is where we are talking of conditioning or based on a time variation. At but some particular point in time, the exceptions are very high, but at other points in time, the exceptions are much lower, right? So these are the ones where we really focus on. These are the ones I have to cover as a part of conditional coverage model. Right? Okay. On an average, there could be 4 exceptions, or probably if I'm looking at 5% VAR or 95% confidence level VAR over a 250-day period, we are saying that at the around on an average around 12.5 13 exceptions can occur. But if this out of this 13, let's say 10 of them are in a particular period itself, this also should be an alarm, though it's in the range and no other exception has occurred at any other point in time. I should really see that this 10 which are occurring in the last 2 weeks or in a very small time period, this should raise a kind of a red flag, which is the volatility has increased during this particular period and it is not captured by the VAR model. Right? Or it could be my traders are taking some kind of unusual positions during this period, which has resulted in exceptions. Now, any of the conditions could come out. Now, this is where we are trying to look at conditioning based on the current situation. And for that, what we see is we again come out with a likelihood ratio test, which is called as a conditional coverage. So probably earlier whatever the coverage, whatever the likelihood ratio test we have conducted, we call it as unconditional. But now we call LR on a conditional coverage model, which means it actually tests for unconditional as well as the testing for independence between the various data points. So here it is purely testing out whether the exceptions that are coming out, right, whether the exceptions that are coming out are serially independent or not. Is there some kind of serial dependency between the various exceptions? Now for that what we are saying is if the VAR is exceeded, so probably let me take a simple example to understand that. Okay, let me give a crude picture regarding this. Right, let's say I am computing the 99% confidence level VAR for this data. Again, here let me tell you I am using the average returns over the entire period. Right, the average returns over this entire period, the standard deviations of the returns over this entire period. I have taken the geometric returns, and what I am simply going ahead with is whatever the 99% VAR that we are computing, which is nothing but, right, I'll compute it in the percentage terms. I am deciding that particular R, which is the mean, right? I am deciding that particular R, which is mean minus 99% is 2.33. So basically I'll take it as norms inverse 99%, times the standard deviation. So what is that I am getting? My VAR in this case is minus 1.73%. Right? This is my daily VAR. Or this is the range. So I am talking about mean minus 2.33 times the standard deviation. Right, mean minus 2.33 times the standard deviation for 99% VAR. Let's say if I want it as 95% confidence level VAR in this example, I'll get it as the mean minus the norms inverse, mean minus the norms inverse associated with 95% times the standard deviation, which is working out to somewhere around minus 1.2. So these are the 99%, 95% confidence interval VAR and 99%. Now here for time being, I am just making it as an exception, for the whole period. I'm making an assumption that the VAR was uniform at minus 1.74. Actually, the better way to work it out is use a volatility estimation model like GARSH or EWMA, find out the volatilities at each of the points, and based on that come out with the VAR estimate separately for each. But for simplicity purpose, I am just to demonstrate this concept, I am trying to bring out that the VAR is uniform at minus 1.74% across. So now what is it? The VAR is said that the loss is around 1.74%. So any VAR that has exceeded any one single day's return, the loss has exceeded that particular number, we'll treat it as an exception. So I'll say if the return on any particular day is even lesser than this VAR, I'll call that as an exception, otherwise I'll not take it as an exception. Now there are some exceptions that have come. So the number of exceptions, if I look at, which have actually occurred during this 1 year period, there are 3 of them, which means the VAR model is computed better itself, because there is an allowance up to 4 exceptions. 4 of them is like a green zone, so there are only 3 of them that has occurred, so that is fair enough. These are the 3 exceptions that have come, and probably I could very well test it with respect to the likelihood ratio test also. Right here we have got the number of exceptions is 3. So proportion of exceptions is nothing but 3 divided by the counting of the total. So the counting is, okay, how many are the t value in our case is coming out as the counting of the total number of exception, total number of sample, which is 243. Now I could have very comfortably used whether my model is whatever the VAR model that I have directly used, a straightforward model. Right, I could use a different model altogether, not a problem. But here I am looking at the likelihood ratio, which is with the unconditional coverage. What is that I am seeing? It should be 2 times log 1 minus of n by t, which is the proportion, to the power t minus n, multiplied by n by t to the power n, number of exception. So this number minus 2 times log 1 minus p. P for me is 99%. So which means I'm taking the P as 0.01, right? P I'm taking it as 0.01 to the power T minus N. T minus N again is 243 minus 3 multiplied by, which is P 0.01 to the power 3, which is directly giving me that the LR is much lesser, right? It is giving me that the LR is much lesser. If the number of exceptions is 5, LR is increasing. If the number of exceptions is 7, the LR has gone much higher, which means 7 is not accepted. So because the number of exceptions is around 3, the LR is much in a limit, which means the model is a decently fit model. Now what is the, it is even in the green zone also. But now what we are saying is, even, okay, let me set, just for the argument purpose, I will set that the VAR model, the VAR that I have computed has given a model of minus 1.25%. The 99% VAR has given minus 1.25%, which has resulted probably in a very big, which has resulted in a very big LR, which means it has to be rejected and the model is having some faulty, because there are 12 exceptions that got generated. But at the same time, I am looking at whether there is some kind of serial dependency or independency that is existing. So first thing is, if var has exceeded, I'll set it to 1, and if var is not exceeded, I'll set it to 0. Then I am finding out Tij as the number. I'll introduce one parameter or one calculation called Tij, number of days in which the state j occurred in one day while it was I in the previous day. So when these two, so probably the changes, the change in the states, if I have to see, I'll look at it from here, saying if this is same as the above, probably I'll mark it with a 0. Otherwise, when these two are different, I want to mark it with a 1. So Tij will tell me in how many days the change of state has occurred, either from 0 to 1 or from 1 to 0. So I'll try to find out the number of days there was a change of state, which is resulting that there are 24 days in which there was a change of state, where the state is j on one day and it was I on the previous day. So this is one calculation that I am taking. Then I am looking at the pi I, which is talking about probability of observing an exceptional condition, probability of observing an exception conditional on the state I the previous day. So when the previous day is 0, so if I say P0, it means the previous day it was a 0, but today it is 1. Right? So probably this is what I want to know. Let's say previous day, no exception. I will simply look at if this is equal to 1, I'll check if the above one is also equal to, if the above one is equal to 0, then I'm counting it. Previous day was not an exception, right? And if the previous day was, if the current day is not an exception, I really don't need to bother about it. So which means I'm counting the number of periods where the previous day was an exception, was not an exception. So the P0 is telling me the total number of exceptions where the previous day was not an exception. There are 12 of them. Similarly, when I am talking about P1, I am looking at previous day is an exception. How do I get that? Again, I am doing the same. If this value equal to 1, I will check if the previous day's value is also equal to 1. Then I will mark it as 1, otherwise 0. In that case, I will find out those days where even the previous day was actually an exception. So this I am trying to count those particular days where the previous day also was an exception. It is 0, right? But just mandatorily let me try changing. Okay, for time being this is P1. So I have P1 as well as P0, which talk about the exception on a particular day where the previous day was not an exception, exception on a particular day where the previous day was an exception. Right? So we are talking about this is the probability. So here this I am taking it as 12 divided by 243, and this also I am taking it as 0 divided by 243, and Tij I am taking it as the number of days itself. Now if today's occurrence of an exception has to be completely independent on the previous day, now what is the test that I am using? I am using a likelihood ratio test in this case. This likelihood ratio test is primarily for the independence, wherein I am talking about 2 log 1 minus pi 0 or P0 to the power T00 plus T01, T0 to the power T00 and multiplied by P0 to the power T01 multiplied by 1 minus P1 to the power T10 and then P1 to the power T11 minus 2 times the logarithm of 1 minus P to the power T00 plus T10 times P to the power T01 plus T11. Now what does this mean? If you look at this particular term, it is talking about the maximized likelihood under the hypothesis that exceptions are independent across the days. P is associated with an exception. Exception are independent, and so this is giving me an indication that the maximized likelihood under the hypothesis that the exceptions are independent across the days, and the second term is simply talking about the maximized likelihood for the observed data. Now once I plug in the formula, I will get in, right? If at all I am looking at the pi there or the p there, it is nothing but T01 plus T11 by T. The number of transactions from 0 to 1. So I am more interested in looking at Tij where there are movements, right? Tij, T00, T01. I can look at each of these transactions. This is T00 as well. T01 and T10 are these two things. And T00s I can very well find out, and at the same time T11 also I can very well find out. Now I can substitute all of them and get the value of my independent statistic. See, basically now if I have to really look at, if I have to really substitute in that, T00 is coming out to be T0 times 1 minus P0, right? T00 is coming out as T0 times 1 minus P0. So how much is the T0? It is coming out T0, which are talking about the total number of zeros, and 1 minus P0 is coming out to this much. And similarly T01. So basically I'll get T00 as T0 into 1 minus P0. T01 will come out as T0 times P0. Means there is a transaction from 0 to 1. So the exception. So whatever are the states in T0. So these are the number of exceptions. So basically what is that I can take? I'll look at T0, which is 243 minus 12. This is T0. Then T1 is number of exceptions, which are 12. Then I am also looking at T00, which is nothing but, or probably if I have to look at T01, number of transitions, it is nothing but T00 or T0 times, I am looking at P1 minus or P0, so around 11.4. Similarly, when I am looking at T0 times 1 minus of this P, this is working out to 219. I am getting the total no exceptions on these two dates, around 231 days when there were no exceptions. Similarly, so this is like the day before there was no exception and today also no exception, T00. The day before there was no exception and today there is an exception, right? So here we are directly finding out, okay, P0s and P1s, actually I am dividing it 12, I am actually dividing it not by 243, but I'll divide it by 243 minus 12. So similarly P1 also I will divide it by 243 minus 12. So overall is working out to this much P1. So T01 is coming out to this. Then similarly I have T10, which or probably first I can compute T11, where the previous day was also an exception, right, which is coming out to T1 times. So my T1 is this much, T1 times P1, which is 0, and this will become T1 times 1 minus P1. 1 minus P1. So this is still remaining to be 12 itself. T10 is remaining to be 12 itself. Now this is what is adding up to the total T1. So from here I can very well find out, now that I have my values, I can very well check for the independence test now. Now that I have almost all the values, if they are really independent, I want my T to be T0 plus T1. My T should be T0 plus T1, and which means the number of exceptions, here should be T times pi. So from here I can get my pi or P, which is the proportion of the total number of exceptions that have occurred, right, which is proportion of the total number of exceptions that have occurred, which is T01 plus T11, T01 plus T11 divided by overall T. This is the value of P. Now from here I can apply the relevant test statistic. The LR, for the independence is what I can really test out. The LR I can test for independence, which will give me 2 log 1 minus P0, right? 1 minus P0 to the power of T00 multiplied by P0 to the power of T01 multiplied by 1 minus P1 to the power of T10 multiplied by P1 to the power of T11. This is one term minus 2 times, if they are independent, 2 times logarithm of 1 minus the combined P to the power. So because we are talking about no exception, I am looking at as T00 plus T10, no exception on a particular day, multiplied by P multiplied by the P, combined P to the power of exceptions T01 plus T11. Now let's say this entire calculation is resulting in yeah, I think because there is not even a single exception which is coming out. That's the reason it is showing a number. But probably if I put up two consecutive exceptions just for the sake of understanding, let me put up two consecutive exceptions. It is directly giving me all the calculations are getting updated. It is giving me my the logistic. It is giving me my likelihood ratio test. The LR value is around 0.96. Now what we are simply saying is, if at all I am going ahead with checking out both for unconditional coverage as well as for independence, both of them. So I will look out for the likelihood ratio for a conditional coverage as the likelihood ratio for unconditional plus likelihood ratio for independence. Now in this case, I would really look out, this would be following a chi-square distribution with 2 degrees of freedom. So I will reject the model if LR is greater than 5.991. But if I am just looking out for the independence test just like this here, if the LR independent is greater than 3.84, 1 degree of freedom for the chi-square, I am going to reject for the independence. So I can say that there is a dependency, but right now we got, now if you see, probably let's try to increase the number of ones just mandatorily. Okay, my LR is still fine. One more one, my LR is still 1. Okay, I think there is some calculation issue somewhere. I think let's address that, right? Because even if I'm increasing the number of exceptions, there is not much of the Tij is talking about. Let me check for this computation. So here actually one mistake came. The P1 is it needs to be taken not as the number of non-defects. I am making a P1 is the total number of exceptions as a proportion of the total exception. So P1 is nothing but the probability that there is an exception on a particular day conditioning on the exception on the previous day. So the P1 actually comes out to this. So which is now resulting in an LR of 14.72. Now probably if I'm working out and reducing these, okay, up to here, even if there are 4 days where there is a repeated one, the LR is coming out to only 3.56, which means I'll not reject the model. The moment it is going much above that, I'm going to reject the model. So this is how we really work out using the independence test and then combining the independence with the unconditional coverage to come out with the likelihood ratio for a conditional coverage test. So probably overall model, if I have to look at one, I'll look at the LR with respect to unconditional coverage. Here it's very high, so I have to reject it. But in some cases, if this is very low but this is very high, overall I should look out rejecting the model if the summation of these two is much higher than 5.991. Otherwise I can very well take the accept the model. So that is what is coming out with the conditional coverage kind of model. So here we have looked at the two. One is the Basel related tools, the other one being the conditional coverage kind of framework. All right.